Hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author creator of Ambroise Method 1.0. Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to Debt Snowball, Debt Avalanche, Velocity Banking. Real quick about my credentials. I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures, and the question posed to me was, James, can you do a basic analysis of the alternative account while mimicking velocity banking? Okay. All right, America, I'll give you 5-10 seconds to take a look at what's on the board, and then we're gonna start with the exercise. All right, America. Now, on the board, we have a scenario whereby the expenses go out first from the alternative account. Then we have another scenario over here where the incomes comes in first. So two separate scenarios. Here, expense goes out first. Here, income comes in first. Okay? All right. But real quick, the interest rate, this one over here, we're dealing with a home equity, a first lien HELOC, so first lien home equity line of credit with not a one-way sweep, but a two-way sweep, okay? And over here, we're gonna be dealing with a credit card. So over here, first lien HELOC sweep, but it's a two-way sweep. Over here, it's a credit card. Okay, but let's first touch on the interest rate, the APR. It's 10% over here, it's 20% over there. Okay, now most of these products, America, are tied to the prime rate. The HELOC, a lot of times with the prime rate. The credit card, they're mostly tied with the prime rate. So for that reason, and not just HELOCs and credit card, you have personal loans. While HELOCs is a mortgage, while traditional mortgage, personal loan, all those things are tied to the prime rate. So for that reason, everything is prime rate. Let's try to understand a little bit what the prime rate is, okay? Now, America, we have something that's called the Fed fund rate, okay? So the Fed funds rate we have what's called the prime rate. And we also have a margin. Okay. Now, the Fed's funds rate, as of right now, the Fed's funds rate, I believe, is 5.25 to 550%. Okay? As you can see, it's a range. Okay? It's not a set number. It's a range between this to that. Okay? The prime rate right now, the prime rate probably 2.75 to maybe about 3%. Okay, that's the prime rate. Okay, and then the margin depends on the customer's credit worthiness. It could be anywhere between 0, 1, 2, 3, 4, whatever. Okay, so as you could see, the Fed's fund rate doesn't have a set number. The prime rate does not have a set number, and the margin also doesn't have a set number. Okay, based on your credit worthiness, it could be anywhere between 0, 1, 2, 3, 4, 5, 6, 7, whatever, right? So now, with the Fed's fund rate, who or which entity determines the Fed's fund rate? Okay, obviously the Fed's fund rate has the name Fed in it, so the Federal Reserve determines the Fed fund rate. It's actually the FOMC committee, but the Feds determine the Fed's fund rate. Okay, so the Fed for these guys, the prime rate. Which entity determines the prime rate? Well, the prime rate is determined by the bank. So by the big bank, by the big creditors. So let's put the bank here. Okay. And finally, we have the margin. Which entity determines the margin? The bank determines the margin. So we have 3 items. The Fed's fund rate, the Fed takes care of that. The prime rate, the banks determine that. The margin, the banks determine the margin. So as you could see, out of the 3 items, the banks has 2 of the 3 items. So this is 1, Fed's fund rate, this is 2, and this is 3. So we have the bank here, 1, we have the bank here, 2. Okay? Now, why are these things ranges as opposed to set numbers? Okay. In the case of the Fed funds rate, the Federal Reserve cannot mandate to the bank what kind of interest rate to follow. They cannot tell them, hey, I want you to, even though I'm Federal Reserve, I cannot tell you what to do. Okay? So they cannot mandate to the bank which one of these ranges should the bank follow. Okay? So as you could see, the bank has a lot of power. Okay? When it comes to this interest rate deal. All right? The prime rate, the banks already determined what the prime rate is, so they're in charge of that. The margin, the banks is also in charge of that. Okay? So as you could see, how powerful the banks are in America. Okay? Now, if we're trying to figure out these numbers, so the base or the benchmark is the Fed's funds rate. So if the Fed's funds rate is 550, okay? And remember now, if the bank has the choice to choose between 525, to charge you 525 or 550, more than likely they're gonna charge you the higher interest rate, 550, okay? And same thing over here, 275, 3%. More than likely they'll charge you the 3%, okay? And the margin is based on your credit worthiness, so it could be anywhere between that, okay? So now, if the Fed's funds rate is 550, then what then will be the prime rate? So the prime rate will be the 550, because remember, this is the benchmark. It's a weak benchmark, but it is the benchmark nonetheless, because why is it a range, okay? Why is it a range? Because the Fed will tell you, regular Americans, what to do, will tell me what to do, but they cannot tell the bank what to do, okay? So 550, so to arrive at the prime rate, you'll be, in the case of the Fed's fund rate being 550, and we have prime rate at 3%, So right now, 550 plus 3%, your rate is already at 850. Okay. And in the case of 10% over here, so which means if the prime rate is at 850, so which means the margin is probably at 150. But let's do our count. 150 is the margin. Okay. So in this particular example, we have the 550 plus the 3%, and here we probably have 150. And in this particular example, that's how they arrive at that 10%. Okay? Because they start with the benchmark, which is the Fed's funds rate 550. They add 3% to it, which is the prime rate, and then plus a little margin. That's how they arrive at that 10%. And again, it's 550 plus the 3% prime rate plus 1.5% margin. That's how we get the 10% over here. Okay? Because remember, all those things are prime rate, well, mostly prime rate. So you have to have a basic understanding in America. What is the prime rate? How do they arrive with this APR that you're being charged on those accounts? Okay? And real quick, let's run it. So I'll make sure I didn't make any mistakes. Okay, perfect. All right, 10%. All right, now that you have a better understanding, who really control these things? Okay, the bank control 2 of the 3, and the first one that the bank cannot control, they still cannot tell the bank what to do, so they are forced to give the bank a range. Okay, all right, so that was on prime rate. All right, America, I'll give you about 5 seconds to take a look at this real quick, and then I'm gonna erase that from the board. Okay. All right. Now, you have my competitor, because remember, my competitor, Debt Snowball, is telling you folks to pay the lowest balance, the lowest balance, the lowest balance, when obviously you could see that the banks are fighting tooth and nails for this interest rate. Okay? So the balance is not the boogeyman, okay, when you're paying off debt. If there were a boogeyman, it would be the interest rate, okay? The Fed cannot tell them what to do, and they have 2 of the other 3 items, okay? So it's not the balance, folks, okay? The balance is not the boogeyman, okay? Remember, these are borrowed money, and interest is the cost of borrowing. So you'll never be the balance, okay? You will always be the APR, okay? So whenever you're paying the low balance and it's not the best approach, because once in a blue moon, it's the best approach now. In the cases where it's not the best approach, because majority of the time it's not the best approach to pay the lower balance, okay? So indirectly, you are becoming an agent to the big bank, the big creditors, okay? Indirectly, because you're forcing them to charge you more interest, okay? And not only that, paying the lower balance, sometimes you do not get the momentum that you're really looking for, because a lot of times you're going for a low baby snowball effect as opposed to a true snowball effect. And I cover all of that in a chapter, I think it was lesson 4, in a chapter that I titled Love-Hate Relationship with Debt Snowball, okay? So, you could go back and watch that chapter if you're interested in that kind of stuff, okay? And I believe it was lesson 4, yeah. The chapter was titled Love-Hate Relationship with Debt Snowball. Okay? All right. Now, let's start with the question that was posed to me. James, can you do a basic analysis of the alternative account while mimicking velocity banking? All right? So I'm going to start erasing some stuff. So on the board, we have a scenario whereby this group, this person, is on an irregular income, okay? And for our purpose, we determine irregular income as somebody who is on commission, perhaps. That's irregular income. Somebody who is on an hourly, regular hourly, but the income fluctuates. For example, say the person works 40 hours, but during the month period, they either got sick or something, so they didn't come to work or something for whatever reason. Okay, either they got sick, so they didn't work for a short period, and then they start working again. Okay, either that or folks who are on commission, or whatever other scenario whereby the income is not regular. Okay, say you have a business or something, and then you know, a lot of small business owners, they have an issue with cash flow. So the cash flow, you know, you did send out the invoice, but the client or the customer paid the invoice at a later time. Okay, so if you offer them terms like net 30, net 15, anyways, we don't want to get too deep into those things. So it's just irregular income for this scenario. Okay. All right. On the board, I feel that I run velocity banking on most of, I did most of it, and to save time, we're just gonna do the remainder, okay? Just a few items, just to save time, okay? So on this one, the current balance on the home equity line of credit, it's a first in HELOC with a two-way sweep, it's 100,000. The interest rate that the person's being charged, the person is on an irregular income, the interest rate they're being charged is 10%. The daily rate, which gives us a daily rate of 27,3973. Okay. Now, this person is on an irregular income, so expense goes out first on this one, and it's 5,100. Okay. So let's figure out what the result is. So we got 100,000, and remember, expense gonna increase that balance. Okay. So if we have 100,000. Plus the 5,100, so we should be at 105. Okay, and the interest still 10%, and the daily rate, so that's 105,100 times 10% divided by 365. That's how we arrive at the 28,7,945. And same thing for the one on top, 100,000 times 10% divided by 365. That's how we arrive at the daily rate, 27,3973. Okay. Now the income on the board, we have cash flow $400. So if cash flow is $400 and the expense is 5,100, so the income would be the 51 plus the 400. Okay, so income is, remember, cash flow is 400. So income is 5,500. Okay, now the results, so we got 105,100. Income gonna decrease that balance because when you send income into that account, it's equivalent to a payment. So a payment gonna decrease that account. So now we have 105,100 minus the 5,500. 105,100 minus the 5,500. Okay, so now we're at 99,600. Okay, and again, the interest rate 10%, the daily rate 99,600 times 10% divided by 365. That's how we arrive at the 27,2877. Okay, and to get an average, we have to add this one plus this daily rate plus this daily rate. So we add those three, 27,3973 Let's run it one more time. So 273973 plus this number 272877 plus that number plus that number 28.7945 divided by 3 because we got 1, 2, 3 of them. So we should be at the 278265. Okay? Number of days in a month, we're assuming this month, this particular month or this particular period has 30 days. Okay? So 27.8275 times 30 days. Now we arrive at the monthly interest charge of 83479. Okay? And the effective rate for this particular scenario is 10.16. Okay? The original rate was 10%. The effective rate is 10.16. Okay? So originally we started at 10, now we are at 10.16. So which means we're in the negative by 0.16%. Okay? The original monthly charge, remember, it was 100,000 if we didn't do velocity banking on it. Because remember, we're mimicking our competitor, velocity banking. So it would have been 100,000, the original monthly interest charge now. It would have been 100,000 times the 10% divided by 12. Okay? So 833.33. That's what the original monthly charge would have been. And our actual monthly interest charge is 834.79. 834.79. So now again, we are at a negative 1.46. Okay? Okay? You see that? So 833.33, but we are at 834, so we are negative $1.46. Okay? That's for that scenario. And same thing on the next one, but this time, what I'm doing here, I reduces the expense by 1,000. So the expense was 51 on another scenario, just so we could do a basic analysis of the alternative account. On the other scenario, this is scenario number 1 and 2, or 1A, 1B. I reduced the expense by 1,000 bucks. So the expense used to be 51, now it's 41. Because remember now, we're trying to analyze the alternative account. We're trying to figure out what happened if we do this, what happened if we do that, okay? So in this particular scenario, we're reducing, like I aforementioned, the expense by 1,000, okay? So when we run the numbers, okay? And same thing on the income, we're reducing the income by 1,000, okay? So the cash flow is still the same, okay? So over here, we got 51 minus the 55, so 5,500 income minus 5,500 cash expenses, cash flow is still 400. Over here, same thing, 4,500 income minus 4,100 expenses, the cash flow is still 400, okay? Because remember now, we're trying to analyze this account, we're trying to decode this account, we're trying to demystify this account called alternative account, okay? So these are some of the tools that we're using to try to understand this account, okay? All right, so over here, 100,000 times 10%, so we had, for daily rate, we're at 273973. Expense goes out first, okay? 4,100. So when you add 100 plus the 4,100, because expense increased that balance. So 100 plus 4,100, so we had 104,100. We're still being charged 10%. So our daily rate is 28,5205. Okay. Okay, now income 4,500. So income, remember, income is like is equivalent to a payment to these accounts. So 104,100 minus the 4,500, so we're at 99,600, still at 10%. So for the daily rate, 99,600 times 10% divided by 365, we add that number. And to get to an average, we add this one, we add that one, and we add this one. So we got 1, 2, 3 items. So after we add those 3, we divide it by 3 to get an average. Okay? And again, we're mimicking what the folks of that velocity banking is doing. So 27,7352 Number of days, 30 days. So monthly interest charge. So 27 times 30 days, 832.05, which give us an effective rate of 10.12. Okay. The original rate was 10%. Now we're at 10.12. So we started out at 10. Now our effective rate got increased. Not good, America. We started at 10. Now this thing got increased to 10.12. So now we are at a negative 12%. And same thing, 100,000, the original monthly interest charge, 100,000 times 10% divided by 12. So we are 833.33. But our monthly interest charge was 832.05, so 832.05. So we have 833.33 minus the 832.05. This time we're at a positive $1.28. Okay? That was the first scenario. So let's run the number real quick on another scenario. This time we're using a credit card. And again, the first one was a first lien HELOC with not a one-way sweep, but a two-way sweep. Okay? And this one is a credit card because there's a new product out there, first lien HELOC, not a traditional HELOC like I mentioned earlier. It's a first lien HELOC with a two-way sweep. Okay? And I'll probably touch on that little later in the lesson, okay, if I remember. Now we have a credit card now. Remember on this scenario, on that scenario, expense comes in, goes out first. But on this scenario, income comes in first. Okay? So we're gonna run the numbers. Okay? So we have 10,000. Income comes in first, so income decreased that balance. So now we have, let's run the numbers. 10,000 minus the 3,500. Because remember, America, to save time, I did most of it, and we're just gonna complete a few items. Okay? Minus the 3,500. So we had 65. $6,500. Okay? At 21%, so when we do 6,500 times 21% divided by 365 to get a daily rate, so we had 3.7397. Okay? Expense, remember the cash flow on both examples, the cash flow is 400. So if income is 3,500, expense will be the 35 minus the cash flow. Okay, so expense will be 3,100. Okay, for this particular example. Okay, and again, cash flow is 400, so 31 minus 35 minus 31. That's how we get $400 cash flow. And the results, remember, expense gonna increase that balance. So the balance right now is 6,500. So 65 plus the 31. So we had 9,600. Okay? And again, the interest rate for the credit card is 21%. So the daily rate will be the 96 times 21% divided by 365. So let's run it one more time. Times 21% divided by 365. So that's how we arrive at the 5.5233% because we're rounding up. Okay? And again, to get to an average, we add this one plus this one plus that one. So we add those three, then divided by 3 to get an average because we're making again what our competitor Velocity Banking is doing. So when we add these three, let's run it one more time. 5.7534, 5.7534 plus 3.7397, 3.7397 plus 5.5233, 5.5233 divided by 3. We should arrive at a 5.0055. Okay? And 30 days, 5.0055 times 30, we had 115.16, which gives us an effective rate of 18.27. Okay? Now the original rate was 21. 21%. The effective rate is 1827, so which give us a difference in savings to 73. Okay, so for this example we were in the negative, but for that example we're in the positive. Okay, now the original monthly interest charge would have been the 10% times the 10,000 times 21% divided by 12. So 10,000 America times 21% divided by 12. So we had 175. Okay, and our monthly interest charge is 150.16. So 150.16, which give us a difference in interest cost savings of 24.84. Okay, and same thing over here, still the credit card. Same thing. In order for us to try to analyze the alternative account, so we're gonna reduce that one by $1,000 as well. So it was 35. On the second scenario, we reduce it by 1,000, so now it's 25. Remember, cash flow is still 400 bucks, so 25 minus the 21, we still got the 400 bucks cash, $400 cash flow. Okay, and we run all these numbers. So over here we have 203. 1908. Okay, so we're trying to figure out what's going on in this alternative account. So that's why we're pretty much testing that account to see what happens if I do this, what happens if I do that. Okay, all right. Okay, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. In previous lessons, I mentioned to you guys that if you are going to use an alternative account, there are 3 preliminary rules that you have to follow 99% of the time. Okay? And the first rule was you may have to change the due date 99% of the time. So changing due date. Changing the due date. And the next set of rules we have, if you're going to use auto pay, auto payment has to be 99% of the time on the account with the highest APR. Okay? In our example, we're assuming there's a credit card somewhere on the board at 26.99%. Okay? And the HELOC for this example is at 10%. Okay? And the last and final preliminary rules that we have is that income has to come in first in that alternative account, and income always has to be greater than or equal to expenses, and again 99% of the time. Okay, and by the way, every time I say 99% of the time, know that there are at least one exception. Okay, so income has to be greater than or equal to expenses. These are our 3 preliminary, let's say 1, 2, 3, our 3 preliminary rules if you're going to use an alternative account. Okay? You have to change the due date 99% of the time. Auto payment has to be on the highest APR account. In the case of a credit card, 99% of the time. And income has to be greater than or equal to expenses 99% of the time. Okay? Now, in this example, this person, whether directly or indirectly, did not follow some of the rules. Okay? We say that income has to come in first and has to be greater than or equal to expenses. But in this particular example, expenses go up first, not income. We want income to come in first, but in this one, expenses goes up first. Okay? That's a violation right there. Okay? Well, James, does it matter? It does. 99% of the time. Okay? Look at the numbers. Okay? Our original rate was 10%. Now our rate got increased to 10.16, which means now we are in the negative. Okay? Now we know that if expense go up first of that account, more than likely the person probably did not change the due date. Okay? Because if you have your due date at the end of the cycle or at the end of the month, at least, because the person's still working, at least they would have had some income, okay, in the beginning that would offset this number, that 5,100. In this scenario, we show that the entire 51 flagrantly went out first, and then the income comes out last. The 5,500 comes out last, okay? So expense went out first, and income comes in last, okay? So which means they did not change the due date more than likely, okay? And since we have, let's assume they have an auto payment, the auto payment, because the way the first lien HELOC is set up, is that all your direct deposit or the money that you earn will touch down the checking account, and that funds now is in the checking account. At some point, they're gonna move the money from the checking account into the first lien HELOC because he has a sweep feature. So in essence, they'll sweep whatever balance that's in the checking account, they'll move it over to the HELOC, okay? But remember, in our scenario, we say there's a 26.99% on the board. This one is at 10%. So the auto pay is on the wrong account because we want our auto pay to be on the one with the higher APR. Okay? We got 10, we got 26.99 for a credit card. 10 is not the higher APR. 26 in our particular example would be the higher APR. So the auto pay is on the wrong account. Okay, 99% of the time. You would have to be, he has to be on the higher APR. Okay? So that's two violations. So possibly on the due date, that's one violation. Okay? The auto payment, it's on the lower APR instead of a higher APR. Okay, that's another violation. And then expenses went out first. When we can for income to come in first. That's another violation. Okay? So very important that when you're doing this, 99% of the time, make sure you change the due date, especially for a scenario like this, if you got sick or something, or you're on commission or irregular income, to where it takes a while for the income to come in. Maybe you miss 3 days of work, 7 days of work, 10 days of whatever, right? So you want to give that account an opportunity for income to come in first. So that's why you move all your due date towards the end. That way you give yourself a chance for income to come in first, okay? All right, so now on this second column, remember we reduce the income by $1,000. We went from 51 to 41, okay? Just so we could analyze this alternative account. Okay, well, let's see what we got. The original rate is still 10%. Our effective rate is 10.12. So which put us again in the negative by 12%, 0.12%. Okay. Now, our original monthly interest charge is $833. But our monthly interest charge for doing velocity banking on the account is $832.05. So now at least we're positive here. Okay. So on this side we're all negative. On that side we're positive. We're negative on the savings side, on the percentage side, but we're positive on the interest cost savings side. And again, this is not best results for having expense goes out first, but at least though, we're not negative over here, okay? But still not the best performance for that account. Because if we have an opportunity to have income comes in first, we would have been in a better scenario. Look at this scenario when we have income comes in first, okay? All positive, positive, positive numbers, positive numbers, positive numbers. When expenses go up first in that account, negative, 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 and we might be positive. Depends, how great the expenses are, how small the expenses are, or how large the expenses are. Okay. So let's take a look at what actually happened, because on this scenario, expenses still go up first, but on one scenario, the expenses is lower on this one, and on this one, on that one, the expenses is larger. Okay? So let's see what happened by $1,000. So we have more expense going out first, we have less expenses going out first to pay off bills, to pay off expenses. Okay? Over here, we are negative 0.16. Here, negative 0.12. Okay? So we're doing better here. Even though we're still at a negative, we're doing better here. Okay? All right. And down below, we're at negative 1.46. We're at positive 128, and again, we're doing better here. Okay? As you could see, when expense goes out first, okay, the greater the expense is, the worse your situation is going to be, your results going to be. Here, the expense is greater than this one, because we had 5,100 here, we had 4,100 there. Okay, 5,100, 4,100. Okay, so expenses is greater here, which means the result's gonna be worse. Okay. Now, on the income side, on this scenario, income comes in first. So we got 35 here, we got 25 here. And again, okay, this column here is greater by $1,000. Let's see what happened. Let's look at the results. The difference in savings is 2.73. The difference in savings over here is 2.03. Okay, as you could see, you save more over here when the income is larger, is bigger by 1,000. So you save less over here because the income is smaller by 1,000. Okay? And let's go down below, 2484, 1908. Okay? And again, you save more here when the income is greater, even though the cash flow is the same. Cash flow is still $400. Okay? Cash flow is still $400. Okay? Cash flow hasn't changed. Okay? 35 minus 31, we had $400. 25 minus 21, we're at $400. Here, the income comes in last, but the difference, 45 minus 41, we're still $400. 55 minus 51, we're still $400. Okay? Okay. All right. So as you could see, the timing of when income and expenses comes in, okay, could be an issue in those accounts. So that's why we set up these rules, okay? 99% of the time, you want to have income. See, we are positive over here. Positive, positive, positive. Because income comes in first. Okay? Here, we are in the negative, negative at least 3 places because expenses go out first. America, you don't want expenses to go out first. Okay? Whether for a short period or whether, in this example, for the entire thing. Okay? Because remember now, this is just an average. Okay? Sometimes if you forget to change the due date, you might have income at some point that was greater than expenses, and then at some point you might have expenses that were greater, because this one we're just using an average. In real life, the results may not be the same, because in real life you have bills that are due. Say you get paid on the 14th, you get paid on the 14th, and then the next one say it's on the 28th. Okay? But you got bills that are due before the 14th. For example, on the 2nd, on the 3rd, on the 5th, on the 9th. So all these expenses are before you get income comes in because you get paid on the 14th. Okay? So sometimes in real life, okay, you might have expenses. So that is why we're telling you to change the due date, because you don't want those bills to be on the 2nd, on the 3rd, on the 5th, on the 9th. Because what that does, remember, your income don't come in until the 14th. And on this account, this dangerous account called alternative account, you don't want your expenses to go out first. Okay? So for that reason, changing the due date to the 28th if you're going to do auto pay. If you're not going to do auto pay, hey, you could pay it on the 29th, you could pay it on the 30th, you could pay it on the 31st. Okay? All right? Very important. Okay? For most folks, the cycle might make a difference. At the end, the auto pay, to changing the due date doesn't cure everything, but it helps quite a bit. Okay? Because remember now, it's not a requirement to change the due date, but it is highly, highly recommended that you change the due date. Okay? Not a requirement. Okay? Highly, highly recommended. Okay? And same thing here, even when you get your paycheck earlier, say you got your paycheck on, let's say you got your paycheck on the 14th, but and your paycheck was only $2,000. Before the next paycheck, say your expenses are like $1,200. Your expenses are like, another expense is like $500. Another expense is like $412. You see? When you add these three up, 1,200 plus 500 plus 412, you are 2,112. So even though the income comes in first, but the expenses surpass the income. The expenses is greater than the income. You see? So now you have more expense again that goes out first. Doesn't necessarily mean it has to come first in the very beginning. Because in real life, okay, you might have the income coming first, but the expenses is doing laps around the income. You don't want that. You don't want the expense to be greater in that account. Okay? Than this account. Because your income's only $2,000. But before you get the next paycheck, which is the 28th, because these, let's say these were due on the 15th, this one was due on the 16th, this one was due on the 26th. See? That's before you get the next paycheck. Your expenses are already greater than the income that you have coming in. So that will create another issue on that account. Okay? And again, that is why we don't want you to have those due dates in the beginning of the year, of the month, or towards the middle of the month. We're trying to have you to push the due date towards the end. That way, that'll give you a little bit of relief, okay? It doesn't cure everything, but it gives you the greatest relief because we want our income to have an opportunity to come in first, okay? I think you guys get it by now. All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right. Now, America, in the case of a first lien HELOC with a sweep checking account feature, let me explain to you guys what that is, and I'll try my best to break it down in a way that you guys will understand this account. Okay? And again, I don't work for those guys. The folks who have that product, I don't work for them. I don't know them. Never met them. Okay? This account, when I was doing my research, because you know I have to do research on those guys, of course, I found out that this account, they called it a first lien HELOC, this product, sweep. Okay? And sometimes the name is interchangeable with an all-in-one loan, okay? But they could be different products, okay? But sometimes they are the same product, or sometimes the names are interchangeable. But we're talking about the best one that they have right now. The best one that they have right now is one that has not a one-way sweep, but a two-way sweep. And when this guy want to be fancy, they refer to it as bi-directional sweep. So bi-directional sweep or two-way sweep. Okay? Now, the way this account works during my research session is that your income comes in, it touches down the checking account. Okay? But that checking account needs to always be zero, okay? Around midnight. So, if income comes in, let's say income is $2,000. So income touches the account, you know, around midnight, the HELOC take a look at the checking account and realize, uh-oh, there's balance in that checking account. Remember, that checking account needs to always be zero, to always have a zero balance. So the HELOC takes a look around midnight and figure, uh-oh, there's a balance of $2,000 in that account, because remember, your paycheck was $2,000. So now let me move that balance of $2,000 into the HELOC. So in essence, the HELOC balance gets reduced by $2,000. Gets reduced by $2,000, and the checking account becomes zero. Okay? So that's how it works. And of course, you have to make payments. You have to pay your bills and everything else. So remember, the checking account is your regular checking account. It functions just like any other checking account. So either you have auto pay, or you're just writing checks, or you're just swiping your debit cards. So now transactions are happening inside that HELOC. But remember now, the balance is 0. Okay? So now you're going into the negative, 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 negative. Okay? Say you swap your card 200 here, 100 there, another 100 here, 1, 2, 3, 4, 5, another 100 here. So now you have 500 in the negative. Okay? Because the checking account has a 0 balance, and then you're doing transaction in that checking account, so you're going into a negative, right? But because he has a two-way sweep from here to here, that's one way. The HELOC, again, around midnight, take a look at the checking account and realize, uh-oh, the checking account is in a negative. Now the HELOC this time send the money back to the checking account. In this case, in this example, the HELOC was sent out $500. So to the checking account to zero out that account. Because remember, the account has to always be at 0 balance. Okay? 0 balance here, 0 balance there. So that's the two-way sweep. One way, the HELOC look to see if there's a balance and hijack the balance or steal it. Over here, when the HELOC realize you are in the negative, so they'll send the money to zero it out. The account always have to be at 0 balance. Okay? So, two-way sweep. The guy who devised that product, you got to give him a little credit. Okay? I don't know these guys. I don't know who they are. But they've noticed that there is a problem and they're trying to find a solution to the problem. Okay? Because what was the problem? In the past, the folks who were doing velocity banking, a lot of times they forget to make the transfer from the HELOC into the checking account. And what that does, because you're going into the negative, all of a sudden now you're being charged overdraft fees. Overdraft fees. Okay? And remember, banks are making billions on overdraft fees. Well, on fees. Okay? So that was the issue that the folks in the past doing velocity banking used to have. Okay? They're doing transaction on the account and they forget to make the transfer. Okay? And another issue they used to have, even for regular transaction, they still forgot to do the transfer. Okay? So this first in HELOC with a sweep checking account feature. Okay? And he has a two-way sweep. He goes both ways, okay, to zero out the checking account. Okay? That provides solutions to the folks that used to do velocity banking in the past, where they forgot to move the money from the HELOC to the checking account in order for them to do their day-to-day transaction or day-to-day, to run their day-to-day activities. Okay? So it's a solution, no doubt. Okay? So that's the importance of having this account. But James, does that mean you approve that product? Guys, my method, when you're paying off debt in general, you will come across 3 separate jobs. Okay? It is a tool, no doubt. All right? But remember, when you're paying off debt, America, you have the T for transfer. You have the A for alternative account, for the folks who are advanced users. We're using alternative account. Okay? And you have the C for cash flow. That's the TAC. Okay? An HELOC because the interest rate is generally lower, so any HELOC or most HELOC are good for transfer. Whether it's a first in HELOC, a BLOC, a PLOC, an all-in-one loan, first in HELOC with one-way sweep, first in HELOC with two-way sweep, all of them combined, if the interest rate is lower, say a credit card, then it's good to use them for transfer. Okay? So understand, remember, we do not practice any form of favoritism, any form of fanaticism. In this case, it's favoritism when it comes to paying off debt. Okay? We use the account or accounts that are best suited for the job. Okay? So these guys here, they are perfect for transfer. Why? The interest rate is usually lower than the interest rate on a credit card. In essence, you're moving, you're relocating high interest rate balances, 26.99, into a lower interest rate environment, the HELOC. That's the first in HELOC sweep. Okay? Now, so for the T, they are perfect. Then we have the A. The A, that's the alternative account for the advanced, for Ambroise Method 1.0 advanced user. Okay, because remember now we have two different types of users on our method. One that uses everything except the alternative account because they don't quite understand it yet. And we call these folks normal user. Then we have an advanced user. And again, the normal user folks, they only use their checking account to pay off debt. They don't use alternative account. So they will not be dealing with that scenario because they don't use alternative account. But our advanced user take full advantage of everything, the T, the A, the C. Okay, and again, T is for transfer, A is for alternative account, and C is for cash flow. Okay? Now, we've determined that the HELOC, the first in HELOC, with a sweep checking account feature, whether it's a one-way sweep or two-way sweep, is good for transfer. Okay? Now, as far as the alternative account, the first in HELOC, America, is not good for alternative account, at least not as a first in line alternative account. It could be a next in line, but not as a first in line alternative account because the interest rate is too small. 10%, you don't want to send your paycheck to a 10% environment when you have a 26.99, a credit card at 26%, at 26.99, okay? So the credit card, for bills that can be paid with a credit card, the credit card should have the auto payment or the direct deposit or the payment should go to the credit card instead, okay? So here, the HELOC, first in line, let's just put first in line, that's a no. If there's another account on the board that has another alternative account on the board that has a higher APR. So for first in line, no. Big no. For next in line, probably. So yes. Okay, no here, yes there. Okay, so you could use it as a next in line alternative account, which means now you cannot have all your direct deposit going into that account, because in essence, if you do it that way, you indirectly converting them to a first in line because you're sending income to them first. Okay, when there are certain scenarios, especially for bills that can be paid with a credit card, you don't want to send your direct deposit to that account first. Because remember, there could be as next in line because the interest rate is considerably lower than this interest rate on the credit card. Okay? So kind of be careful now how, when you're sending paycheck in, I know some company they allow you to do direct deposit on multiple accounts. Say for example, you could have direct deposit going to this account, a portion of your paycheck, and you could also have direct deposit going to another account, a portion of your paycheck, the remainder portion. Okay? And sometimes they allow you to do two, some of them allow you to do more than two. Okay? But remember now, you have to let them know in advance how much to go into which account. And that's when that might create a little problem, because remember, your bills every month fluctuates. Whether you have credit card bills, they fluctuate. The minimum payment is not always the same. Okay? So for that reason, even when they offer you the flexibility to have two separate accounts to split your paycheck via direct deposit, you still got to be careful, because remember, again, your bills, your expenses fluctuate during a period throughout the month. Okay? I mean, from month to month, it fluctuates. So you don't want to have a set number, because you have to tell them a set number or a set percentage. You know, how much needs to go into account A, how much needs to go into account B. Okay? Because, you know, so for that reason, we'll prefer that you just have it on your regular checking account, not the one that has the sweep attached to it. Because remember, the way this thing is set up, the way I understand it, okay? And again, I'm not their agent, I never met them, I don't know these guys. But the way he's set up is that once the account touches down the checking, around midnight, they're gonna move the money over, and you don't want that, because like I said earlier, you indirectly convert them to a first in line, because now you're sending all your income to it. You know, this account is not first in line. This account is at 10%. Okay. From prior lessons, we've learned that your movement of income and expenses should happen inside the account with a higher APR. Okay. So, and again, we could use them for transfer, because the interest rate is usually lower than a credit card. We could use them for alternative account, but not as a first in line alternative account, but we could use them for next in line, because the first in line offer greater results and reducing interest cost, but the next in line offer greater liquidity. So this one very liquid, okay? Especially with this two-way sweep feature that they have, okay? Now, the third and final job is cash flow. Cash flow is better served in the account with the higher APR. And by the way, the higher APR doesn't always have to be a credit card. It could be a personal loan. So if we have a personal loan on the board, this one, the credit card is at 20. The highest credit card we have is $26.99. If we have a personal loan at, say we have a personal loan, let me put it here instead. Say we have a personal loan at 29%. Okay? So cash flow will go to the personal loan instead. It's not always the credit card. Okay? Because remember, we're sending cash flow where cash flow is better served. Okay? So, in this particular example, if we have a personal loan, you would have gone to the personal loan 29%. But we don't have personal loan, we have credit card. So in this particular example, you'll go to the credit card. Okay? So as you could see, we could use the first in HELOC. Take that off because we don't have a personal loan. Okay. Yeah, so we could use the first in HELOC for transfer when it makes sense. Okay, if it's good for that job. For alternative account, it wasn't good for the job, at least not as a first in line. We could use it as a next in line. Okay. In cash flow, this HELOC definitely was not good to keep the cash flow because it's at 10%. You don't want to set your payment, your cash flow to a 10% environment when you have a 26.99% environment. Okay? So the credit card in that particular example will receive the cash flow. Okay? So America, let me give you 5-10 seconds to take a look at what's on the board, and then we're going to continue the exercise. All right, America. So now, as you could see, this account for transfer, it was okay. For alternative account, this first lien HELOC, let me erase some stuff. This first lien HELOC for alternative account, first lien HELOC, two-way sweep equals poor performing alternative account. Okay? So know when you could use them, know when you cannot use them. Okay? So for alternative account, the first lien HELOC with a two-way sweep or bi-directional sweep is a poor performing alternative account because they were at 10% and the credit card is at 26.99%. Okay? Don't want to send payment to a 10% environment when you got a 26.99 because you're not going to get greater results sending it to the 10% when you have a 26.99. And this account, at some point, it'll be like a impound account, a holding account, an escrow account. So later on, maybe these guys, especially in the case of the Velocity Banking Group, they'll wait 3 months, 6 months, 9 months to send the next chunk to that credit card. And again, when you have to deal with extra payment, don't wait, okay? Because you wait, you lose, okay? Because you're saving 10% here, plus doing velocity banking on that account, which will give you a boost, but the boost will not be big enough to make up for the difference in interest savings and interest. So, because you're gonna have 26.99 on the credit card and 10% here, so the difference is 16.99. Doing velocity banking on that account, okay, not gonna make up for the difference in interest, okay? And we covered that lesson on, we covered that aspect of it. I think it was lesson 3. I think it was lesson 3. I don't remember, but I think it was lesson 3. Okay? So, poor performing, the HELOC is a poor performing alternative account, you know, as an alternative account. Okay? You could use it as next in line, but you cannot use it as a first in line. Okay? Because it's not going to give you greater results. Okay? Because these guys only offer greater liquidity. Okay? Not greater results, America. Okay? So that was the first lien HELOC. And same thing, if we had similar example for a PLOC. Same thing. A PLOC would have been a poor performing alternative account compared to a credit card on the board. Okay? Same thing, if we have similar example with a BLOC. Poor performing alternative account when we have a credit card on the list that has a considerably higher APR. Same thing if we had a traditional HELOC, not the first lien HELOC with a sweep, we're talking about traditional HELOC. Same thing. The traditional HELOC would have been a poor performing alternative account compared to a credit card on the list. Same thing if we have an all-in-one loan. Okay? And again, sometimes these two names are interchangeable, all-in-one loan or HELOC, but they could be different product because in the past they have one of them with a one-way sweep and now they're coming up with a two-way sweep. Okay? So same thing, all-in-one loan would have been a poor performing alternative account. If we have similar example where these guys are 10%, okay, and we have a credit card on the board that are 26.99%, okay? Can I use them as a first in line alternative account? And again, those are for bills that can be paid with a credit card, because we know credit card is limited, because there are certain bills you cannot pay with a credit card instantly. We're talking about instantly now, because there are still creative ways where you could pay almost most of the bills or all bills with a credit card. There are creative ways to use a credit card for everything, or most everything. Okay? All right. And again, the HELOC, the first in HELOC, whether it's a one-way sweep, whether it's a two-way sweep, the PLOC, the BLOC, the traditional HELOC, the all-in-one loan, okay? They are all poor performing alternative account when you have a credit card on the board, okay? Can I use them as a first in line where they receive income first for everything? No. So you gotta be careful, okay? Because even for a few days, you don't want to send income to these accounts for a few days. Even for a few days, you send income to them, which means you're earning the 10%. That means for that few days, whether it's 3 days, 5 days, 10 days, 14 days, for that number of days, you're losing somewhere else $26.99. Okay? And again, even if you use it, even if you do velocity banking on it, okay, still not gonna make up for the difference of 16.99%, because 26.99 minus the 10, we had 16.99%. 99% of the time cannot make up for it. Okay? So not as a first in line. Okay? And definitely not to keep the cash flow. Okay? You want to send cash flow to a 10% environment when you have a 26.99% environment. Okay? I think you guys should get it by now. All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Don't give me money. Don't give me power. After God, America, give me numbers, okay? Because I love working on that stuff. All right, I think that's it for me today. Again, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0, our basic version, because we have another version, Ambroise Method 2.0, where I cover more advanced scenario, more advanced case studies, okay? Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to Debt Snowball, Debt Avalanche, velocity banking. Until next time, America. Good morning.